What is up, Steve here? I hope you are doing well. I came across an article that I want to talk about because I think it is significant in terms of where we're going to see mortgage interest rates go. If this is the current trend of where things are headed, I foresee mortgage interest rates just going to keep increasing, and I believe that they could increase to astronomical levels. And if they do, then I believe that we're going to see a lot more turmoil in the real estate market and property values coming down, which could be good for a lot of buyers as well. Even with, as I always say, even with mortgage interest rates really high, I would always prefer to buy a property very low with a really high mortgage interest rate, because I know in the future I could refi that, sell it, or whatever the case is. But buying really high and having a lower interest rate, I just am not a fan, unless the property really made sense. So right now we know that the Fed is basically quantitative tightening, meaning they're not buying mortgage-backed securities, or they're letting them basically roll off the books. And with them not as a buyer, there's other buyers in the market for mortgage-backed securities. However, with the price of real estate, how high it is, and rising mortgage rates, the buyers of mortgage-backed securities are going to want a higher return. So, which is, I think, further going to push up mortgage rates as well. So basically, this article, and I'll leave it in the description for you guys as well, it goes on to say, roughly a year ago, the Austin-based fintech began to sell its loans to First Guarantee Mortgage Corporation, better known FGMC, lender and investor that specializes in non-qualified mortgage loans. Now, a non-qualified mortgage loan basically doesn't meet the standards of a traditional mortgage, so they're more non-traditional in terms of how they underwrite the loan. So these could be, and we saw a lot of this in the last real estate recession, this could be like basically stated income loans or bank statement loans, where they're just relying on what you're stating is how much you make, or bank statement loans where they're just looking at your bank statements and not basically underwriting with your tax returns. So they're basically essentially more quote unquote riskier borrowers. So goes on to say, Up Equity sent between 30 and 40 loans per month to FGMC worth about $60 million in total volume. FGMC approved loans to purchase at a rate of 5.3%, locked 20 days ago, according to Wilson, but now rates are around 6%, and investors are asking for higher premiums to invest in these assets amid a flight to qualify caused by expectation of higher U.S. Treasuries. FGMC sent a warn notice to Texas Workforce Commission on Friday, explaining the company has decided to terminate the employment of 428 of its 565 employees on June 24th, which is about 76% of their total workforce. Obviously, there's some turmoil going on now, or is it based on delinquent mortgages? Who knows, but I'm assuming that there's some issues here. FGMC has experienced significant operating losses and cash flow challenges due to unforeseen historical adverse market conditions for the mortgage lending industry, including unanticipated market volatility. So this is just one company. I'm assuming this company is going to be very comparable to other mortgage-related and lending-related entities out there that are probably having similar cash flow issues as well. And if this is basically the writing on the wall as to what's going to continue to happen, as well as with the Fed not buying more mortgage-backed securities, it could mean mortgage interest rates could essentially skyrocket on us. And if they do, and we see that happening, I'm going to say, if we go into double-digit mortgage interest rates, we're going to see a tremendous hit in value on real estate, because something has to give there. It either has to be lower mortgage rates, which we saw in the pandemic, below 3%. People are going to be able to, their purchasing power is going to be much higher, right? And with mortgage rates rising really high, we're seeing it right now, even at 6%. People's purchasing power has diminished greatly at 6%. Imagine if that doubles to 12%. We could see properties decrease more in value. And a quick story on this too. When that happens, there are going to be sellers out there that bought cash, paid cash, or they might be older in age and owned investments completely in cash. And that could be opportunity as well, especially if you guys have a good down payment to buy properties in the future at fairly decent price with good terms and everything else. So start stacking the cash, because there's going to be a lot of opportunity for owner finance deals. And I did one when the market crashed. I paid a little bit higher. This house I bought, it was on a full acre of land. I bought it for 89 grand. Excuse me. And I got the guy to hold paper. I reached out to the real estate agent and I go, hey, I see that this guy has no loan on the property and it's been sitting on the market. It was sitting on the market for like 200 days. And I reached out to him, and the real estate agent, she's like, no, he's not willing to owner finance. And I was like, have you had the conversation with him? And she's like, being around the bush. So I just told her, I go, look, I'm going to send you an offer owner finance deal. I'll send information about me as a borrower as well, and see what you can do. Now, I wanted the owner finance deal instead of just a traditional loan, kind of twofold. I got a better interest rate from the guy. I did it fully amortized over 12 years. So fully amortized over 12 years. I had a good downstroke on the property, but also it wasn't even livable. This house was beat to shit. 2 years down the road, after fixing it up and everything else, I took that acre of land that the house is on. I was able to split the back half acre of the land off of it. I sold that for 30 grand. And then the house on the other half acre, I think I sold it for like 180 or 190,000 bucks. Looking back on it, I probably should have just kept that property. It was fully amortized loan, rented out, and then that property would have been, paid off in another 10 years with the tenant paying the mortgage on it, basically. But I think that when the real estate market does turn, you have to be creative as well. And the people that get creative are going to get the better deals out there. And I encourage you guys, if you guys are investing in real estate, just pick up as many books or watch as many YouTube videos of different ways of acquiring real estate. There's ways of acquiring real estate too without any money of your own as well. We'll do some more videos on that too. And even if you're early on and you have no money, I mean, you could even, if it's legal in your state, you could even sell contracts, basically lock in the deal and then flip the contract to somebody else and get the spread on that deal. I'll link a couple other videos that I did on how to go about doing that as well. But anyway, I rambled on a little too long. I appreciate you guys being with me today, and I will see you guys on the next video. See you.